Imagine checking your investments and discovering that the stock market hasn't simply fallen, it has stopped producing believable prices. A $40 security trades for 1 cent. The safest asset in the world suddenly becomes difficult to sell. Officials respond to a crash by making lower prices illegal. And on one terrifying day, Wall Street survives because bags of physical cash arrive at exactly the right location. These aren't hypothetical scenarios, they actually happened. Here are 10 times the stock market lost in ways almost nobody talks about, beginning with the crisis that forced one private banker to act like America's central bank. Number 10. Wall Street was rescued by a physical delivery of cash. In October 1907, a failed attempt to manipulate the shares of United Copper helped trigger runs on financial institutions connected to the speculators. Fear spread through New York, and the supply of money available to stockbrokers began disappearing. The interest rate on overnight loans backed by stocks jumped from 9.5% to 70%. 2 days later, it reached 100%. At certain moments, brokers reportedly couldn't find money even at that astonishing rate. Without new loans, they would have to liquidate their clients' stocks. Those forced sales could push prices lower, trigger more margin calls, and create even more forced selling. JP Morgan persuaded banks and major corporations to contribute emergency funds. The money was then physically delivered to the loan post on the floor of the New York Stock Exchange. Before digital transfers and modern central bank interventions, the survival of Wall Street could depend on whether enough currency reached the correct part of a crowded building. But 7 years later, officials confronted an even larger danger by refusing to let the market open at all. Number 9. America temporarily outlawed lower stock prices. When World War I erupted in Europe in 1914, American officials feared European investors would sell their U.S. securities, convert the proceeds into gold, and move that gold overseas. On July 31st, the New York Stock Exchange closed. It remained closed for approximately 4.5 months, the longest shutdown in its history. Closing the exchange didn't eliminate the desire to sell. Unofficial transactions continued away from the main market, where prices were less visible and harder to verify. When official stock trading finally returned, it came with restrictions. Committees established minimum prices, and certain securities could not legally trade below those levels. The market had not discovered that those stocks were worth more. Authorities had simply prohibited it from reporting anything lower. It was an early demonstration of a principle investors still forget. Closing a market doesn't eliminate losses. It can merely hide the price at which people are willing to sell. 15 years later, an attempt to prevent speculation created consequences far beyond Wall Street. Number 8. The effort to cool the 1929 bubble helped tighten credit around the world. The usual account of 1929 focuses on investors buying stocks with borrowed money. Some buyers reportedly put down only 10% of a stock's price and borrowed the rest. What receives less attention is the Federal Reserve's response. Officials believed speculative lending was diverting money away from productive businesses. The New York Federal Reserve pushed for higher interest rates, and its discount rate eventually reached 6%. Under the international gold standard, however, American interest rate increases placed pressure on foreign central banks to raise their rates as well. Credit became tighter, international commerce weakened, and economies began sliding toward recession. Yet the American stock boom continued for a time. A policy intended to restrain speculation in one market helped spread tighter financial conditions internationally before that market finally collapsed. Decades later, Wall Street experienced another sudden collapse, but this one had no algorithms to blame. Number 7. A flash crash happened when price information came from paper ticker tape. On May 28, 1962, the Dow fell 5.7%. Heavy selling overwhelmed the system that reported transactions to investors. The ticker did not finish printing trades until roughly 2 hours after the market had closed. Investors were reacting to prices that could be dangerously out of date. In the over-the-counter market, some dealers widened the gap between their buying and selling prices to as much as 30 or 40% of a security's bid. Others refused to provide a firm buying price at all. Modern crashes are often blamed entirely on computers, high-frequency traders, and fragmented electronic exchanges. But the 1962 break contained many of the same ingredients: delayed information, vanishing buyers, forced selling, and market makers backing away from risk. Technology can accelerate a panic, but it did not invent prevent panic. Number 6 began with a railroad, but its most dangerous consequences appeared at companies that didn't operate a single train. Number 6. One bankruptcy made investors distrust hundreds of unrelated businesses. Penn Central was once the largest railroad in the United States. When it filed for bankruptcy in June 1970, the failure shocked a market most viewers have never heard of: commercial paper. Commercial paper consists of short-term corporate IOUs. Companies use this funding for ordinary needs such as inventory, bills, and payroll. After Penn Central failed, investors questioned whether other companies might also be hiding serious problems. Businesses that depended heavily on commercial paper suffered unusually poor stock market returns, even when their operations had nothing to do with railroads. Investors were no longer evaluating each company independently. They were rejecting an entire method of financing. The Federal Reserve responded indirectly. It made funding available to banks so those banks could lend to companies that were suddenly unable to refinance their short-term obligations. The market loss revealed that a company's share price can collapse because investors distrust its funding pipeline, not necessarily its products. Number 5 was the most famous one-day crash in American history, but America wasn't its greatest victim. Number 5. The country hit hardest by Black Monday was New Zealand. On October 19, 1987, the Dow fell 22.6% in a single session. In today's market, an equivalent percentage loss would erase several thousand Dow points before the closing bell. But Black Monday was not simply an American disaster. Markets were becoming technologically and financially connected across borders, allowing fear to travel from one time zone to the next. New Zealand's stock market ultimately fell around 60% during the episode. The country barely mentioned in most Black Monday documentaries suffered a far deeper collapse than the United States. The crash also inspired market-wide circuit breakers. 10 years later, those protections finally faced a major test, and the result wasn't reassuring. Number 4. A circuit breaker may have encouraged investors to sell faster. On October 27, 1997, turmoil associated with the Asian financial crisis reached the United States. After the Dow fell 350 points, the rules stopped trading for 30 minutes. When trading resumed, prices quickly fell toward the second threshold. At 3:30 in the afternoon, the 550-point trigger ended the session early. Traders later told the Securities and Exchange Commission that the first shutdown had accomplished little. Some observers feared that a visible countdown toward the next halt encouraged people to rush their orders into the market before the doors closed again. A mechanism designed to slow panic can unintentionally give every seller the same deadline. Regulators later redesigned the system around percentage declines rather than fixed Dow point thresholds. The next crisis didn't begin with an unbelievable stock price. It began when an investment designed to remain at exactly $1 failed to do so. Number 3. Lehman's most contagious loss appeared inside a supposedly cash-like fund. 2 days after Lehman Brothers filed for bankruptcy in 2008, the Reserve Primary Fund announced that losses on Lehman's short-term debt had pushed its share value below $1. In financial language, the fund had broken the buck. That tiny movement below $1 had an enormous psychological effect. Investors treated money market funds as places where cash remained stable. If one fund could lose money, they wondered which fund might be next. More than $400 billion was withdrawn from prime money market funds. Funds needing cash sold short-term corporate debt, making it harder for companies to finance normal operations. A loss connected to one investment bank was now threatening the machinery businesses use to pay their immediate expenses. The panic became contagious when something that looked like cash stopped behaving like cash. 2 years later, the market produced prices so ridiculous that regulators canceled thousands of transactions. Number 2. $40 securities traded for 1 cent. During the flash crash on May 6, 2010, approximately $1 trillion in market value briefly disappeared. More than 20,000 trades across over 300 securities occurred at prices at least 60% away from their earlier values. Some securities traded for 1 cent or less. Others produced executions as high as $100,000. One reason involved something called a stub quote. A market maker that didn't genuinely want to trade could post an absurdly low bid or high offer merely to satisfy its requirement to display prices. Those quotes were never expected to execute, but when ordinary liquidity disappeared, incoming market orders reached them. Regulators ultimately canceled transactions in hundreds of securities and introduced rules preventing market makers from posting quotes so far away from the real market. The episode exposed a disturbing truth. A price can exist inside a trading system without representing anyone's serious opinion of an asset's value. And number 1 involves the asset investors were supposed to trust when everything else was falling. Number 1. In 2020, investors sold the safe haven to obtain something safer. As the pandemic panic accelerated in March 2020, investors desperately wanted cash. They didn't just sell stocks and corporate bonds, they also sold enormous quantities of US Treasury securities. Market liquidity deteriorated, bid and ask spreads widened, and some longer-term Treasury yields began rising under the selling pressure. Hedge funds alone reduced their Treasury holdings by an estimated $141 billion during March. Treasuries still carried extremely low default risk, but that didn't guarantee that every holder could sell unlimited quantities immediately without disrupting prices. The crisis revealed the difference between safety and liquidity. An asset can be highly likely to repay you in the future and still be difficult to convert into cash today. Across all 10 stories, the pattern is remarkably consistent. Crashes are rarely caused by falling prices alone. They become dangerous when lending disappears, buyers retreat, information arrives too late, or supposedly safe assets stop behaving the way investors expect. The most revealing question is not simply how much did the market lose? It is, what did the loss expose that had been hidden during the boom? Which of these events surprised you the most? Tell me in the comments and subscribe if you want more financial history that goes beyond the stories everyone already knows. Because the next market crash may look nothing like the last one, but the weakness it exposes is probably already hiding in plain sight.